Bonjour. Good morning. Great to see you. Or great to see your messages. How is everybody today? Refreshed, I hope. Yesterday, I messed up this page, didn't I? But I hope as we were going, you understood it. I'm going to open a clean page for us. And I'm going to send you a couple more pages, but not right now. I just want to demonstrate this and then I'll send it to you in a break. Searching for my document. I don't see it. And after the class, or towards the end of the class, I can spend some time if people have questions about the assignment due tonight, okay? But let's get through this material and then we'll talk about the assignment. So stay tuned for that. I don't see my document. Hold on. For some reason, maybe it's still sending. Sorry, I'm not looking at the chat right now. I did see your greetings. I just can't. Let me go out. Let me go out and come back in. I'm looking for 15.12. I don't know why this is so hard. Why can't I see it? What I'm going to do is just go in another place that I know it exists. Let's get it from here. Okay, so these are the clean notes. There's some extra pages in here, but I want to discuss short selling. Okay, so what's short selling? I will send you these pages. Okay, during the break. All right, so short selling, to recap. Short selling is the sale of a security that the investor does not own. How? The security is borrowed from a broker and sold in the open market. The cash flow at the initiation of the short sell, your only cash flow, is the proceeds from selling the security. So you borrow. We'll assume that it's at no cost because you already have an arrangement or relationship with the broker. And the only cash flow is when the holder of this security sells the security in the open market. At some point, the term expires, right? There's a closing of the short contract or arrangement. Eventually, you will have to buy back the security in order to return it to the broker. What is the cash flow? The cash flow at the elimination of the short sell, this is your only cash flow, is the price that you have to pay for the security in the open market. So short selling takes place when individuals believe that a security is going to lose value when the price falls. Okay, so when they believe the security is going to lose value, what they can do is short it if they can find a broker that will lend it to them. So this would be a broker who has a difference of opinion, I guess, who will lend it to them, and then that investor can sell it in the open market, make experience a cash inflow of the market value of that security, and then when the price has dropped, coincidentally, yes, to close the short, the arrangement or the contract with the broker, he's buying the security from the open market at a reduced price, okay? And in the interim, he experiences profit. So this is what investors would like to do, is identify stocks that are, or securities that are overvalued, and they know the price is going to drop, or they believe the price is going to drop. So if you've watched the news in the States and over the last several months, they've talked a lot about shorting securities, and it's become more popular in circles or in internet chat rooms where unsophisticated people are realizing or trying to realize profits by short selling, and they're really upsetting the market players, the market makers. So this is interesting. This is just an interesting story to follow. It's really important to understand what shorting is. So now in our scenario, how we've used the concept of short selling is we've created risk-free borrowing lending by introducing the shorting of a T-bill. So we achieve risk-free or riskless borrowing and lending. Here it's not exactly the story that I've mentioned where you imagine the price will fall or anything like that. All I've explained here is that okay, let me go through it and then I'll tie it in with what I just said. So the security of interest is the Treasury bill. It's a zero coupon bond issued by the government. So many governments issue T-bills with a face value of $100. So this is just an example with numbers so you can follow. And with a maturity no longer than 1 year. So it could be 3-month T-bill, it can be 6-month T-bill, okay? But less than a year. If the yield on a 1-year T-bill is 5%, then the price is currently this. Now we know this. There's no coupons. It's just a pure discount bond. So this would be the price, correct? Because of the time value of money. $100 in one period. So we say we're going to make it a 1-year T-bill to make things, the calculations simple. So what's going to happen is arrangement is made with a long-standing broker to borrow the T-bill and sell it on the open market for $95.24. The short sell proceeds, this is a cash inflow of positive $95.24. Oops. Now, in a year, the short needs to close. Closing of the short is where at the end of the year, the investor buys the T-bill back just an instant before it matures in order to return it to the broker. So the current market value is really the face value of the T-bill. So the T-bills sell in the open market after the initial sale of the government, right? So they resell in the secondary markets. So the price you'll have to pay as an investor doing this for the T-bill will be $100, right? Because time has elapsed and that's the face value of the bond. So this transaction is equivalent to borrowing. So this is just like borrowing $95.24 with a 5% rate of return or interest. The idea being that you can use this money towards the market portfolio and earn a higher rate of return. Remember, the market portfolio begins, in many examples, higher. Well, it begins higher than the T-bill rate, right? Risky securities have a higher rate of return. So let me send you those. Let's take a big little break. I'm going to send you those, and then we'll come back and talk about this. I have to finish this. I'm going to clean this up a bit before I leave you for an instant. What should I clean here? It's so messy. But as we were going along, you understood, I hope. You can watch the video to understand better. Maybe I can use this. So I've just explained what a T-bill is. What short selling is. Do you have any questions about short selling? Yeah, it's going to be faster to erase with a big eraser. So I can review this and then we can do some exercises and move on. So this week we're going to finish the UR case I gave you and the weighted average cost of capital, and then next week we're going to talk about capital structure and what is the appropriate amount of debt, or how do corporations consider debt issue versus security issues, so stocks versus bonds, shareholders versus creditors. Okay, so here's my clean. So I'll be right back, okay? Yes, Jeff Day, you're talking about GameStop. So that's an example for people who are not familiar with it. Okay, I'm going to take just a break to send you that document. Okay, it's not as easy as I thought. It's taking me forever. Okay, I'll just have to do it during a longer break. This break isn't long enough. All right, so where we left off. We left off with... Okay, we were talking about K. We're talking about K. So K is here is a security. Oops. Okay, with this level of risk, highly sensitive to market returns. But this level of return down here, and I explained that if CAF-M holds true, and all the assumptions inherent in it, and there are a variety of assumptions, and I'm not going to get into them. Then presumably investors aware of all this information could create this level of return for that, taking on that level of risk. So why would they invest in K? So what will happen, so I discussed this at the end of last class, what will happen is that investors currently in K will identify it as overvalued. It's overvalued. Okay, so it means that how are prices determined for a stock? I've talked about this a lot. We assume constant rate of return or required rate of return, right? So dollars invested in this company will otherwise always consider this as the required rate of return or opportunity cost. So if not in this security, in some other security with this rate of return due to this level of risk. And so there will be a downward pressure on the price since investors currently holding K will realize that this is not the required rate of return. This should be up here. And then they can create this by combining the market portfolio with leverage, borrowing at the risk-free rate. So they could create this portfolio here with M and short selling T-bills. So what's going to happen is that people currently holding K would want to get rid of it, and they'll get rid of it. They'll convince, they'll offer lower and lower prices to get rid of it. And this affects, or this, presumably the dividends stay the same. This affects, to balance this equation, the price. Now the required rate of return. And what is the required rate of return? I've been telling you that we are finding it. That's what we're doing here, is trying to find it. And we write it like that. So as the price adjusts, this is a price adjustment that affects directly the expected return. So because of the very existence of this portfolio, investors in K will realize a price drop and subsequent expected return increase. So that's the adjustment process for K. Prices will fall. And I mentioned towards the end of the class, I said that when stock are overvalued, the price is going to fall. This is when investors should short K, because they know the price is going to fall, so they should borrow it, and then from a broker who already has it, and then presumably the broker willing to lend it, unaware that the price will drop. If they can find a way to short it, they'll realize the difference when they try and sell when they buy back the stock to close the short, the price has dropped. So they will get the proceeds, and then the price will have dropped and they return it for a discount. All right, so I've said a lot here. I've talked about different kinds of shorts, so don't get confused. But these are the options. So what about, I left you then with the question of what happens if you have a security here, J. For this level of risk, investors only require this level of return. So investors currently happy with this level of risk, so this is their risk tolerance or their risk preference. Seeing J will want J, right? For this level of risk, they'd like this level of return. So what will happen? Well, they'll bid up the price of J because they recognize that it's undervalued. They want it. And more people wanting it, more investors wanting it, will have people currently holding J only willing to sell it for higher and higher prices. So how does that look in terms of the adjustment process? For the adjustment, what I'm going to do is I'm going to make this bigger so I can fit it in. So as the price is bid up, I keep on touching the wrong things. So as the price is bid up, presuming that that dividend doesn't change, then the adjustment process involves I can't fit that in. Let me do that again. Or I'm going to call the required rate of return the expected return on I. Then to balance this equation, there has to be a simultaneous drop in the expected return. Okay? So that's how J adjusts. It's currently undervalued and the price will rise. In other words, that is an indirect way of saying that the expected return will drop. So the price will rise and the expected return drop. And what do investors looking at J do? So people who don't have J, people looking at J, they should buy it, right? That's what we said. They should long it. It's called long. Or hold J in their portfolio because the price is going to go up. So they buy it and hold it. So that is the adjustment process, and that is the capital asset pricing model. And we usually have to say that CAPM holds. Any questions? You have to long and hold J. So securities above the line will adjust to the line. They are currently undervalued. Securities under the line will adjust to the line. They're currently overvalued. And I described the adjustment process. So all securities, all investments, all assets fall in this line. And then there's just some comments here. All right, so let's look at some exercises. Let's see what we have to do. Let's do some things together here. So we just did you have the answers, but let's discuss them. Let's see if I can. Okay, let me just go through what we have here. So the first one is working with inflation rates again. Okay, the effect on an index stock. Okay, so you can try that. That's just time value of money. This next problem, let's try this one. This problem involves, I believe, the dividend growth model. Let's work on this together. Number 2. I'm going to extract it. So this is document 29. So when it mentions the market return and the risk-free, you know it's hinting at the capital asset pricing model there. But then it starts talking about the constant growth rate of dividend. When it talks about the constant growth rate of dividends, you will be thinking about the dividend growth model. So there are two. So far we have two models in terms of pricing assets or determining their required rate of return. There's the dividend growth model and the CAPM. And you'll see exercises practicing with both. So Samuel just asked me a question. Even the prices go up when it goes down, it is not good for the investor, is it? Sorry. I'm not sure. Do you mean when the prices are, when it's overvalued, or do you mean when the prices go up? I'm not sure. The question, let me see. So you take advantage, as an investor, understanding this. If CAPM, if you were in a world where the CAPM hold and there's this line, if you believe that's where we are, then if you have an asset here, you should short the asset. So you're not buying it. The price is rising, the expected return is rising, but the price is falling. It's currently overvalued. So what you should do is you should make an arrangement to short it. It means that you are going to borrow it, sell it, use the money in alternative investments, and then when you close the short, the price has already fallen, so you're buying at a discount. It's a bargain. And then in the meantime, you've realized the profits of using the proceeds for other investments. Did I answer your question, Samuel? Alternatively, if you have an undervalued stock, you should buy it and hold it, and in the meantime, you see the price will go up. I don't know if you can see what I wrote there. So review what I said there. Let me know, during the week if you have difficulty understanding the results. We'll talk about it. Okay, good. All right, so where were we? So we were here. So what do we have? We have the beta. That's good. This is the beta of Viva. It's the only stock we'll talk about, so we'll just leave it like that. Beta is 2.25. It's very sensitive to the market returns. The stock's current price is $12.50, so that's going to be PV0. And it will pay its first regular dividend in 1 year, so that will be C1, right? But they don't give you the value. If the market return, is, so this is, the market return is recognized as the market portfolio. So this is like ERM. You'll notice later I go to lowercase r's, but okay, so it's ERM for now. And it's 10.6%. And please don't hesitate to ask me questions about any of the notes I gave you, even from the first material, okay? If you don't understand, well, I guess Taylor is helping you, but if you don't understand, please let me know. Then the risk-free return is 4%. And remember, I don't put an E because there's no variation, right? I don't put an E in front. And there is a constant rate of growth in dividends of this. Okay, so this is the G. This is G. All right, so what we want to find out is the dividend. Now, where are we going to get the dividend from? Does anybody know? What formula should I use? Well, without looking, of course, at the solutions. How will I get the dividend? Good morning, Limon. So where will you get, this is document 29, where will you get the dividend formula from? Nobody knows? I've given you a lot of time here. Okay, so you have no idea. Where are we going to get this from? Okay, so I mentioned these two models here. So we're actually going to use both. So what we need to do, we want to find the dividend. The dividend is in the equation of PV0 equals C1 over I minus G. Now, what do we have? We have the price. We don't have this. We have G, and we don't have this. So there's two unknowns. We don't have the dividend to be received and then which we know will grow at a constant rate. So we don't know I. We don't have I anywhere. We don't have the required rate of return. So let's get first the high required rate of return, and then I'm going to write it in black. So your first step is to find the I, the required rate of return, the cost of equity, for valuing these dividends, right? The future cash flows. So that's what we're going to do. So let's see, what does the CAPM say? Now let's write the CAPM formula. CAPM formula is that the expected return of any security is equal to a markup above the risk-free rate, because all investors will hold the T-bill. All rational investors will hold the T-bill, but also some portion of the market portfolio. But to enjoy or to be incentivized to hold the market portfolio, we need to think about the risk inherent in the relationship between the added asset to the market portfolio. So what I'm going to do is adjust for the market risk premium for every unit of risk. So that's my formula. So I'm going to take 4%. I can write it as percentages. 4% plus the beta, remember, is an index. It's not a percentage, it's an index. And then the market risk premium, which I can calculate, I can put the numbers in. So the market return is denoted as 2.6%. And then the risk-free is 4%. So I can write this as percentage. And you find the risk, the rate of return. The required rate of return is then this is 6.6% times 2.25 as an index, and the 4% here. You can use the whole number of percentages as long as you remember their percentages. So this is 18.85. So that is the required rate of return that you should put in here. And so you can solve this for the dividend. Okay, so what do you get? I know the price. I have to go back up. Oh geez. Let me get this. Let me try this. I know the price is here. Let me do this on the side so you can see everything. So the price is $12.50. That's here. And the dividend is what I want. And I just figured out that well, I can use decimals here. Oh dear, again. 1885 here. And the growth rate is 0.0605. And that's it. So then I can solve for C1 algebraically and find the dividend. So we use both the CAPM and the dividend growth model to solve this. And we did all of this assuming CAPM holds. Always know your assumptions. What do you get? When you solve this, you get that this bottom part is 0.128, and then you multiply that by 12.5 to get $1.60. And that's my final answer. Okay, so this was part 1. And this is part 2. And I used both CAPM and a dividend growth model to get that result. Oh, Kelly, Louis, Charles, check. Double check your answer. The algebra. Or maybe it's not clear here. Verify. Very good, Francette. Anyone else get that value? Okay, so good. No questions, comments? Let's go back to the exercises and look for another one. Let's see. So this one here, number 4, is like what we just discussed, or similar. So work with that and let me know if you have questions, okay? And then here, here are some information using betas. Okay, so that you can do these. These are not hard. I think that was the hardest one on that one, or more challenging, because you had to use 2 concepts that I don't often bring together, in the same problem. So you have answers for all of that. And let's see what I want to do next is a continuation of the UR case. Let me see. I'm looking for the notes called Risk and Return Cap M. I think it's this one. No. That one. 28. Okay, so these are the notes. All right, let's open this case. So this is a continuation of the UAIR case. What we want to do next, remember the UAIR case where I gave you information and you solved the capital, well, we solved it together, the capital budgeting for UAIR, and determined that it was worthwhile to invest in the Bahamas flights. It was worthwhile to invest in the Bahamas line, so travel to the Bahamas. And then we used, at that time, we used a discount rate of 10%. And now what we want to do is make sure that if we include other information, we will get the same result. We want to verify that if we use other information, we should remain with the 10% required rate of return. So we want to see what is the value of, or what is the required rate of return by UAIR and its shareholders. What is the cost of equity from this perspective of UAIR? And in an efficient market, we say the cost of equity of UAIR is the same as the required rate of return to shareholders holding UAIR stock. So those are the same. I will use those terms interchangeably. So let's read this part of the case. So this is part 2. So UAIR, a hypothetical leading American airline which transports passengers, cargo, and mail to 63 cities in North America. UAIR provides jet services to cities located in US, Canada, Mexico, Europe, the Middle East, and the Caribbean. In 2010, the airline was considering opening a new line to the Bahamas. Okay, so you know this information already. In the following year, UAIR's long-term bonds are current. So now this is new information. UAIR has bonds that are traded at 6.04% with an annual effective yield to maturity. And the current T-bill rate is 1%. So this is all this new information. How does this affect things? The point is UAIR is not an all-equity firm. It also has to consider debt and creditors that they have to pay. Now, this is going to affect the required rate of return for investors in UAIR who are partially invested as both bondholders and shareholders. And that's really important to UAIR because UAIR pays out, from their perspective, cost of, for every dollar invested, they have to pay both shareholders and bondholders. So we need to consider that carefully. So we're going to move from cost of equity, which is just stock, so we refer to the discount rate that we use, or the interest rate, or the required rate of return, as the cost of equity. For bonds, what do you think we call it? So for stock, it's called cost of equity. For bonds, we refer to it as cost of debt. And for companies that issue both stocks and bonds, what do we call the required rate of return we should use? So we refer to firms with debt as leveraged. No comments? For leverage firms, what we want is called the weighted average cost of capital. That would be the I. So I keep on saying I because we're going to use it as the required rate of return. We're going to name it different things, but it's essentially the same idea. It's our opportunity cost. Okay, it's the opportunity cost of investing. It's the price of investors foregoing current consumptions to invest in either equity in a firm, debt in a firm, or a mix of both. And from the firm's perspective, they have to pay their required rate of return in efficient markets. Okay, so hopefully you're following. So this is it. This is the terminology. This is what we're headed for. I need to combine these into a new thing called the weighted average cost of capital. All right, so what did we do? What do? We have all this information because what we need to do is use the capital asset pricing model to help us. So I need to know about the T-bill rate. I need to know about the stock returns over time, and I need to know about the market returns. Now note that I am using historical data now, okay? Even though I taught you a lot using the data with the probabilities, you should be able to go either way. So I'm going to focus on historical data right now. You also have information on dividends to make an estimate using, we're going to try and use so let me make some notes here. We're going to try and use the capital asset pricing model. So you're given that information to use that, and you're also going to try and use what's called the dividend growth model that we just applied, which is simply the basic formula for valuing stock that we've been using all along. I'm just looking for the different variable. To use a dividend, oops, that doesn't look very clear. So that's why they've given you this kind of information. And then we're going to ask the question, or answer the questions. Okay, returns for US stock and the S&P 500 index and the 90-day T-bill rate are given as follows. So this is historical data that you have to compile to use CAPM. And then you have information on dividends to help you compile the dividend growth model, because you're going to compare the findings. And you're given information on your stock are currently traded. So you have the price of the stock and the corporate tax rate. And these are the questions. Use the dividend growth model here. And then here, use the capital asset pricing model. And then what I ask for here is in a leveraged firm or levered firm, that's a firm with debt, because this was talking about all equity. Notice, all equity firm. And this is for equity. But then I start talking about the levered firm, so that's with debt on the balance sheet. And then I tell you some information, and I ask you to find the weighted average cost of capital, which is known as the WACC. So you have all the tools to do this. In fact, we'll solve this together, but you do have all the tools to do this. It might be easier as I present it to you. So follow along or rewatch the video later, and hopefully you'll follow as well. Okay, there's some extra questions here that we will address. So what I keep on doing through these problems is changing. I'm going to change the beta. So initially you're given a beta, then, oh no, we calculate a beta, but then we change the beta. Oh, it says 3.5. I think I use 5.5 in the notes. Anyway, we'll have a look. And then I ask you to reassess the Bahamas project with the new rates that you found. Okay. So you ready? You want a break? Take a 5-minute break, and we will pick up with these notes in did I even put them here? Let me pull up the notes that we're going to look at. It's document 28. No, we did this already, didn't we? We did this already. 28 is done. We want to do okay. It's called 31. It's after 30. Okay, so 31. So this is what, so there's going to be a ton of calculations that we're going to make here. This is document 31. Okay, I'm back. I sent you the short selling notes, so you have those. And let's get into it. Oh, some questions. Yes, Ernst Sham, but the administrators would like to have a independent assessment. They want to ensure that there is no collaboration and that students are working independently, and it's worth 20% of the grade. So as far as the last test goes, you will have to check with the administrators. If there's a way to monitor students that can't make it, then it's possible, where students will work either with observation on camera or something like to that effect. The fact that we are throwing out monitoring or proctoring out of the exams begs the question of integrity. Okay, we have an integrity issue across the board, not just in Haiti. It's a problem here at the university as well. Now, although I give my students the control of the exams and I trust them to work independently for the first several assignments, then at the end I like to give a final test that is proctored, and I can do that remotely. So students that can show up at the school in Port-au-Prince could show up, and the ones that cannot can arrange to be proctored remotely. Maybe that's one option. Okay, so I will mention it to the administrators, and it seems that they really want to do it this way. So that's what we're aiming to do together. Okay, so let's continue with the material. All right, so this is document number 31, and you notice these are the same formula, but I've introduced a lowercase r instead of the capital R. So I hope that doesn't bother you. It's just the idea that to remind you that what we're finding is I or R. It's just the required rate of return that we're looking for. The appropriate risk-adjusted rate of return, required rate of return. That's what we're trying to find. So some textbooks use R. I use I to be clear. Just to be further from R, because you see so many R's floating around. So you can use I or R, and here I put R's, but lowercase r's. All right, so what we want to use is the CAPM to estimate the return to stock. So that's equivalent to ERI that we saw in the previous notes. And we need to use, well, we're going to use this form of the beta, which I explained to you is equivalent to this form of the beta. Notice that I'm putting in here the notation X and Y because market is X and the stock is Y. Right, so the market's on the horizontal and the stock is on the vertical. So the vertical would be sigma X over sigma M. Let me do that again. So these are the same formula, but I'm going to use this. I'm going to use this version because here you have to calculate three things: correlation and the two standard deviations. But since correlation is actually the standardized covariance, why don't I just use that? So that's what that is. All right, so we begin with trying to compute the beta. The beta is the sensitivity of the stock returns to market returns. So here is information on the period 2005. I have to fix that to 2005. To 2010. And what should we do? We need to calculate the beta. So what is the beta made up? Covariance and variance. So we're going to use this form. So we need to get the variance of the stock market returns and the covariance of the two returns. Would you like me to do this in Excel? You have all the results here, but I can perform this in Excel if you like. Would you like that? Okay, so let's take these values over to let's take these values with us over to Excel. Okay, so let's put in year. Remember to refresh your screen if it looks blurry. So I'll put this as 0.0491 and then 0.1579. Oh, that didn't work. 0.0491. Keeps changing the format. And now I don't know how to fix that because I'm not familiar so much with Excel in the iPad. Change format, formulas, draw. I'm gonna have to just do it somewhere else. Here it is. Okay, it worked. Okay, so then 0.0549 and then negative 37 and then 2646 and finally 0.1506. So that is for the market returns. And so we've seen some of this data before. This is just more of it. These are all in percentages. So these are really high rates of return. So the returns initially were 10%, and then in 2006, 30%, and then 10%. And then this was the bad year, right? This is the stock market crash, or the worldwide economic crash in the markets. So this represents a recovery of some sort, and then the last year, 2010, was 30%. Okay, so we have those numbers. I have to open this file. Well, let's go back and see what we did. So then with this data, what did we do? We need to calculate the covariance of returns and the variance of returns, right? So we can do that. You can do that in a table, or in Excel, I think we can just ask for the values. Actually, we can just do this on our calculator. We can just put this information in the calculator. Let's do that. Well, there's a lot here, but just seems so much easier in the calculator. Let's do the calculator method. So what I'm going to do is open the calculator and go to second data. There are numbers there, so I need to clear the worksheet. Second, clear work. So now it's clear. And I start entering into X the market returns. So I enter 0.0491. Enter. I'll do it in both. Okay, let me do it this way first. And then the UR as 0.1. The second pair is 1579. And then for Y is 30. I have to check my entries later. And then 0.0549 and 0.1. and then negative 0.37 negative, and 0.55 negative. So put the number first and then the value. And then 2646. Enter down. And 40. And finally 1506 and 30. And scrolling through, verifying my entries. Oh, that one didn't work. 0.1579. And then 30, and then 0.0549, and 10, and then negative 37, and negative 55, much more sensitive, you see, for UAir, much lower than 37, 26, 46 for the next one, and then 40, and then 1506 and 30. And now you ask for statistics. And you get from the linear results, you get the sample size, right? So 6 observations. Here's the mean of the X, that's the market. Here is the standard deviation of X. Here is if it was calculated for a population of data, but we will treat it like it's a sample. And here are the returns, that's the average return to UAir stock, which is about 10.8%. These are the standard deviation of returns, and here is if there was a population of data, but it's not, it's just a sample, so we use that one. And then we get if there was a slope and an intercept. So if there was a correlation between these, then we would use the line. So these are the line parameters, or sorry, the estimates for the intercept. This is the estimate of the slope. And it's a very good fit to the line. Almost 1, well, it's practically 1 is the R. So we got beta. That's the beta, 1.55. Does it directly for us. So I've done it in the notes to show you can do it, and I'll do it in Excel as well to replicate what's in the notes, but we got the beta already. That's the slope. That was our goal, right? To find the beta, so I got it, 1.55. So how would you do it here? We want the slope. Probably can do it just the same. But I don't want to fidget with this because this is not exactly the way I'm used to seeing things. I would have to draw or chart. No, that's not drawing. I want a chart. So anyway, don't worry. So let's do it. If we did this to replicate what we have in the notes, I would calculate step by step the means, right? So the average of each. So why is this different from what we were doing before? Because the data is historical data. It's straightforward. This is the mean. And this is, oh, I can copy it over. So that would be the mean of the S&P 500. That's the mean of UAir. That's X and that's Y. And then the standard deviations, do I need them? I don't actually need them. I just need to get the covariance because, well, I have to get the variance. Let's just get the standard deviation. So the standard deviation is equal to standard deviation. And you just get these ones here. I hope it works. Oh, didn't like my abuse of the formula. Okay, there. And then copy that here. So that's the standard deviation. So we can actually get the variance of the market returns, which we need for our formula. All you do is you square this. So that's what we have. We need this figure. And we need the variance of the market returns. So this is X for market. And this is Y for the stock. And what we're interested in is calculating the slope of the linear relationship between them. So the beta is going to be equal to the covariance of X with Y divided by the variance that's going to equal, how am I going to find the covariance? I have the variance, I have the variance here for X, right? And I just need the covariance. Can I just do covariance? Let's see. You can explore Excel. You don't have to wait for me to show you. Let's see, covariance, and I probably have to highlight all, this and this. And it doesn't matter the order. Is that the right number in the notes? Let's see, 0.06317. Let's go back and look. Oh, something happened to I think my thing shut down. Okay, so what did we get? Covariance, nope, a different number. Okay, so this is going to be a slightly different number because these are all rounded, you see? Everything is rounded here. So it's going to be slightly different. Let's continue going. I'm going to make this a little smaller. Let's continue going and see how it changes things. So if you did things manually and you didn't hold all the decimal places, you'll have a slightly different answer. And then here's 0.04 for the market. Let's see, 0.4048. Okay, so this looks correct, 0.048, and then this one is slightly off. Let me make sure I did it right. Looks good. So let's continue. Let's get the beta and see if it really makes a difference. So the beta would be equal to the covariance divided by the variance. What do we get? It's different. Very different number, right? So What did I do anything wrong? Because the calculator gave me the right answer. Well, maybe I have a value entered wrong. Let me check. Because they should have basically the same result. So let's see, 0.0491. Maybe it's doing something different in the calculation. Maybe I want a different formula, I'm not sure. Let's see, something's wrong. Let's try this one. Covariance of the sample. We'll treat it like a sample result and see. So we'll use S. So it's good to be able to calculate things when you don't know what you're doing. You've not used a system before. It's good to calculate them different ways and confirm. Is that the right number? I think that was the right number. Let's see. That's the same number. So that worked. So I don't know what covar is, but it's not covariance. So you need to use covariance with a S for sample to get this number, and now things will work out just fine. All right, so now we got the right answer. The formula here was covariance with an S for sample. So when you use Excel, make sure you know what you're doing. Check the definitions of things. It says here I. I don't know why it calculates the wrong number. I guess it's divide. Maybe it's the population one. It might be the same as the population calculation, but you want the one for the sample. Okay, now you get the right answer here. All right? Questions? So we found the beta. We found the beta at 1.55. And we can round it. I said, unless if you continue to use Excel to solve your problem, you don't have to round it. But for this exercise, I'm going to round it to 1.55. So that's it. So if I did this manually, I would have to get the means. Remember, deviation from the mean. And deviation from the mean is what I calculate. This is the covariance term. Remember, the hats are because this is historical data. Those are the notation for historical data with hats on top. Chapeau. Okay, any questions? So we found the beta. The beta for UAir is estimated at 1.55. Now this is just UAir operations, has nothing to do with the new project exactly, unless you think that the UAir project will operate similarly to the rest of the other operations of the firm, of the airline. So let's continue. All right, so here what we're going to do is try and use the cap M together with the beta when we have the beta. So remember, the cap M traces risk to return with that line. with the security market line. So if you have one of those, you can find the other. It traces risk to return using the security market line. So as long as we have the beta, we can get the ERI and vice versa. If I have the expected return, I can get the beta. So you have to think of the line. So what do we need? Here is the formula for CAPM, and I'm writing it as R, not RI, but ERS. The E reminds us that there's randomness. They're not all the same value. The lack of an E in front, or expected value, reminds you that there's no variability here. It's always the same rate. And then this is your beta for the stock. And this is called the market risk premium. Now, we're going to approach this slightly differently than we did in the other exercises. The information that we have for T-bills is the historical T-bills just over the recent past. And the recent past has been volatile. So you see T-bill rates have dropped considerably from 3%, 4% down to 0%, almost 0% in these latter years. Okay, so this is a 3-month T-bill. And since they're so volatile, so different than what we're used to, we're going to just focus on this episode or this period to estimate the average T-bill rate. So you can get this by calculating the average. And for the market, we already calculated this before. This is the market average, which is over here. We already calculated it. Right here. So we're going to use that together with the average from here. And we're going to calculate a risk premium, historical market risk premium for this period. And this is what we get. It's quite small, because the market returns are small relative to what happened outside of this, right? The market returns, if you remember in the notes we were looking at, the market returns are in the order of 11% historically, but this is about half of it. Look, so that's what we got here. This is from here, right? So 5%, and you got to think about, compare that to over the last almost 100 years. So over the last just about 100 years or so, the stock market returns used to be around, well, before this period, like we just took a period of 7 years, 1, 2, 3, 4, 5, 6 years, as opposed to hundreds of years. And it's small, right? It's small compared to what we're used to. So what happens is We're going to do that because we believe that in the future, after 2010, it's going to stay about the same. So we want to use information that's closer to the period that we're estimating for. And given around 2010, there weren't any major changes to reinforce the confidence in the market, it would be believed that things wouldn't change so much. So using these, this is the estimate for the market risk premium, very small. So let's put in here, notice this RF is this 2.365, which is different from the T-bill rate. The current T-bill rate is 1%. So I'm going to use 1% here. Actually, let me round. So that's going to be 1%. But this RF is a different RF. This refers to this data here. Let me use color coding. I'll color it so you can follow. So let's say I'm going to use yellow or green. Can you see green? Yellow. Okay, so the yellow is what I did. So that's different than the current T-bill rate. Maybe I'll put a black with it or something, a thin black. Just in case you can't see. Okay. All right, so what happens? What we do is now calculate for UAIR's required rate of return. So UAIR should be using a required, given that this information is valid, we think UAIR should be using a required rate of return of 5.273277%. That's using the CAPM, assuming the assumptions of the CAPM hold. Now, what did we actually use? For UAIR, we use 10%, but now we found a reason to use a different number. This number will make accepting projects for the UAIR airline much more possible, right? Because of the low required rate of return. All right, now let's change some things up. So we're going to present alternative estimates for the required rate of return. First thing we're going to do this several times, so keep up with me, please. Stay with me, please. First, I'm going to use a longer time period to get a historical market risk premium and show you what happens. So if we go to the original data that I mentioned to you between 1928 and 2010, so it's like almost, well, that's 80 years of data. Why, yes, it's 80 years of data. And the average T-bill rate over that period is 3.7%. And the average return to common stock is about 11.3%. So remember these numbers. We drew the normal distribution for these numbers. So well, at least for the 11%. So the average historical market risk premium then is much higher. So now we're getting 7.6%. So changing this amount to using a longer time horizon makes, because this goes up and we're adding, the required rate of return goes up to 12%. So this is saying that UAIR should consider or rationalize why not to use this 12.795. If this was used it's almost like 12.8% as the required rate of return, the Bahamas project would have been rejected. So this is very different, and you have to make a statement of why you're choosing the one you will choose. We are going to make the statement that this is very different than if you use the last 6 years of the T-bill data. This required rate of return makes it less likely that the project will be accepted. When these are different, the convention is to use the more current data. Okay? So we're going to use the more current data for a robust or reliable estimate of the cost of equity. So in calculating the cost of equity, the rate of return we should use to determine feasibility of our projects, we will use more current data as opposed to all of the data available. Okay, so this, again, this RF and this RF are different. This RF, how did I mark it here? With a red. This RF is still the 1%. This RF is historical, that comes from all the data between 1928 and 2010. Okay, so we have settled that we are going to use this one here up to this point. With the information that we have, we're going to use a required rate of return for UAIR of 5.27. And this will call our required rate of return using CAPM. What if we use the dividend growth model instead? So we learned about the dividend growth model. I did an exercise applying it, but in that exercise, I gave you the G. I wanted you to use this version of the formula but I gave you the G and some other things, and we wanted to find this. That's what we did. So I gave you all of these, or we were able to calculate this, etc., and then we found this, remember? In the exercise, the practice exercise that we did together. So what we're going to do now is use it exclusively to solve for I, which we will call the return, the cost of equity. So find the cost of equity using this information. So this comes from the case. So I'm going to let you look at that for a moment if you haven't had a chance. And then I'll discuss it. Have a look at what's happening. All right, let's see what I did here. So here's the information on dividends paid to shareholders. Per share dividend in 2005 is 20 cents. And then this increased over time, and it's not a steady, well, I mean, it's a steady increase, but what we're going to assume is that there's a constant growth rate over time, and we want to find what that growth rate is. So what we're going to do is take the first period's dividend and grow it for 6 periods to get the last period's dividend. And in this way, we're finding the average growth rate. It's kind of like a geometric average in a way, but we've assumed they're all the same. So this is something we've seen before. It's like finding the EPR as well. So we've assumed there's growth that's the same all throughout, and just solving this expression makes us go to the power of 1/6 and minus 1 minus off the principal, right? So we use growth factor of G and solve to find the growth rate is approximately 3.8%. I will not round intermediate calculations. I keep them as they are. I can store this in my calculator to use it. All right. Just be clear. Hold on. That would be stored. This one would be store 1, and then this one would be recall 1. So what we found is the dividend, the next period dividend. We need that because in this formula we need the next one. So if we want the cost of equity now, we need the next cash flow. The next cash flow would be the dividend 1 period from now for shareholders. And then the price is given for now, so that's here. So let's make this clear. This is now, and then this is next cash flow, D2. So you know a year has to pass, right? Or 1 period has to pass. And then, so we have this is next period's cash flow, which is the dividend. We have this, which is the current price, and we computed the G already, and we stored it. So let's put those numbers together, and we calculate a new rate of return that's very similar to the one we already have. Now, be aware of the assumptions that you use. You assume that growth will continue indefinitely to do this, and that's really important. So that's an important assumption here for the dividend growth model. So you can either just use it to say, well, this seems close to what we had before. Using capital asset pricing model, we got 5%, almost 6, right? What was it? Let's see. It was 5.27. So I'm not going to say it's exact, but this is similar to the result using CAPM and we can say this reinforces what decision am I talking about? I'm talking about decision to use the more current data. So this says this number is similar to the result using CAPM, which was 5.27. This reinforces our decision to use this. I'm going to make that and I want to reinforce it versus the almost 13% figure. Okay. So we're not going to use this number because it required an assumption we're not prepared to make. So we're going to, so let me write that down. Always be aware of your assumptions. Now, it's tough because firms don't always pay dividends. They may choose to retain earnings and not pay dividends. So assuming constant growth of dividends is a big assumption. Also assumes that the firm is growing. Okay, so all right, so we're going to continue using the 5.27 figure. So we proceed with that 5.27 figure. And what we're going to do is evaluate UAir again. So these were the total project cash flows that we computed. And remember, we got an IRR of 10.26%, and we made the decision to invest when the required rate of return was 10%. Well, it's no different now. Our required rate is even lower, so we still invest. If we had gone with the other CAPM estimate, we would have rejected the project. To the Bahamas. So all these numbers should look familiar to you. These were the cash flows that I derived with you. And then this is the NPV using, look, the new rate, and you see that the NPV is $6,000, showing that it's a profitable, promising project. Well, what if the firm, well, let me show you a couple of things and then we'll talk about what if. What if the firm, because the firm right now has been assumed to be an all equity firm. And the other assumption that we've used is the Bahamas project's beta is the same as the UAir beta. So let's look at varying these assumptions and how does that change our decision. Before we do that, just want to plot on here, the UAir project would be up here with this rate of return, and its required rate is 5.27. So this is a undervalued project. It should be pursued. All right. So you can plot projects just like you do other securities, investment opportunities. So have a look at that. Notice I put the RF here. I didn't even plot the market portfolio, but the market portfolio would be here. And this does better, this performs better. Or sorry, this performs better than the market portfolio. We only required 5.2% for this level of risk. The market portfolio, remember, was very low. If we go back to plot it, we got the market portfolio was 0.0511, remember? So if we use that in our graph, M would be down here. Let me just plot it because that would be M. Me and my pen. M, and that would be, you see, beta of 1. It's always 1. And the expected return to M was 0.051. Let me go back again. Was it 1? It was 1.2, I guess. Sorry, I'm flying through this. Okay, that's lower than UAir. Okay, so that's just tying that back in. Notice the notation I just used. UAir. The S is generic, but that would be for the UAir project. And also that I use the average historical, but only over the past 6 years. And, just to clarify what version of the capital asset pricing model I used. And this is the current T-bill rate, not the average. Because investors would compare against the current T-bill rate. They will hold the T-bill rate that's current and then adjust their expectations, their expected return for the risk inherent in projects or securities, projects, assets, adjusting them by the market risk premium. Okay, that's the average historical in this case. And we were very clear that it's current historical, not the full historical. Like, I only went back 6 years. Okay, so that was dealing with UAR as an all-equity firm, but what if it's not? What if it also has debt? So, what I want to do is, we don't have a lot of time, but what I want to do is introduce how we incorporate debt into our consideration. And then when we come back next week, I'll pick up here and I'll review from here, okay? And talk about this some more, but you should be able to work with the materials I sent you after this discussion. I will spend about 10 more minutes talking about how to include debt. So, keeping in mind, firms are not all equity finance. Here's the balance sheet. And you have here what the firm claims as assets is this balance by what it owes. It owes shareholders and bondholders their fair share. So we value firms, in fact, by their financing. The value of a firm is equal to the market value of the assets of the firm, as measured as outstanding stockholder or outstanding shareholder wealth and outstanding bondholder wealth. So these are the notation I'm going to use. So S is for stock or equity, and B is for bonds or debt. And so I'm just introducing some terminology. RS, right, is the return to equity, and beta S is the measure of systematic risk of equity. This is the sensitivity of those returns to that firm to market returns as measured by a broad index. And debt, we'll use the notation as this is the return to debt, and this is the beta of debt. And just like other assets, if we assume the capital asset pricing model, we can trace these through the line, the security market line, just like, and this one as well, just like we had before. So now we need to consider the market value of assets of the firm. So I'm going to talk about the return to assets as the cost of capital, and it's also the return to the average investor in a levered firm, so a firm with debt. And the beta of assets would be a measure of the systematic risk of a levered firm. And again, you could trace risk to return through the CAPM if we assume the CAPM assumptions hold. Some more notation. S is the market value of outstanding stock. And RS is a return to shareholders. B is the market value of outstanding debt. I've already said this, but anyway. RB is the return to shareholders. So this would be this is like the required rate of return. And here we would call this the yield to maturity on any debt. Okay, so this is where the different terminology comes in. It's a bunch of different I's, interest rates floating around, and so you can tag them with the asset you're talking about. They have different names to refer to them. Okay. The return to assets then, so would be the return to the average investor in the firm. And average in what sense? Well, an investor in the firm will be considered average if they are invested in the same proportion that the firm has ownership. So shareholders are or claim on the firm. Shareholders share, if it's an all equity firm, would be 100%. Their share could be calculated as their share over the value, but if it's all equity, this will be 100% because B will be 0, right? If it's all equity. And an all debt firm will have equity of 0, so that will be 100% ratio. And that brings us to the levered firm that only has average investors. They will be partly invested in debt and partly in stock. Now there's all kinds of investors. You have shareholders, bondholders, and the average investor. This is very important because we're going to use it as a metric. We're going to use it for to help us to determine the cost of capital. So some other terminology, right, to put it here. So this is also called the cost of equity. This is also called the cost of debt. And this one is called the cost of capital, but more specifically, we have to talk about the average investor. And when we do that, we're talking about a weighted average. So we refer to the weighted average cost of capital. And the acronym spells WACC, WACC. All right. So I just repeat that here, which you can read. And here is the calculation of WACC. Like any return to a portfolio, you have to think about, remember we talked about this, the return would be a weighted average of returns of all the assets in the portfolio. So we'll see that the average investor in the firm has like a portfolio, partly in risky stock and then partly in debt. They have partly stocks and then they have bonds. And we want to sort out what is the required rate of return for an investor in the firm, the average investor. And here is the weight for equity times the return or cost of equity. And here is the weight for debt times the cost of debt. Now tell me, why is this here? And I explain it below, but what is this all about? This is really important that you know this. Why have I taken the cost of debt and multiplied it by 1 minus TC? I'm pausing because this is really important and I want you to remember it, if you didn't know. The fact is, and this is really important, that bond payments to bondholders are interest payments, right? Interest payments of RB for every dollar invested are tax deductible. So there's an incentive here for firms to issue debt and realize cost savings as a result of the tax deductibility of those payments. And the tax savings, so this should look familiar to you. When you want to figure out tax savings, you take your tax rate times whatever it is. Before we used depreciation, right? That's what we used before in each year that we depreciated an asset. But now it's regarding the per dollar investment in debt or bonds. So this is the tax savings. This captures the tax savings. So as a result, if a firm has to pay RB for every dollar invested in bonds, but gets tax savings of TCRB for every dollar invested in their bonds, then this is really the cash outflow of the firms to its bondholders for each dollar invested. Okay? So this is the figure that goes here for that reason, because of the interest payments being tax deductible. And so where does that take us? So that takes us to, and I'll talk more about that, the UR case and recomputing using the information provided. You're provided information in the case part 2 about the debt issued by UAIR. UAIR issues bonds with yield to maturity of 6.04%. You're also told about the proportion. You're given this figure as the proportion invested, or the proportion of stock to total assets and the proportion of bonds to total assets. So you're given these numbers. These were all given. So you can compute, you can practice this, you can compute the new CAPM cost of capital, and we call it WACC, the weighted average cost of capital. It goes down because it is dampened by including a lower risk bond. Why do I say lower? Well, initially it's 6.04 and the required rate of return is 5.27 for equity, but you have to multiply these together to understand the cost of debt. So if I multiply those together, what do I get? It's smaller. It's going to be 0.03624. Okay? So it is the case that debt as a weighted average with equity, their costs per dollar of the firm will be lower. The opportunity cost will be lower than if it was an all equity firm alone. So it does go down. This makes investments more likely, right? Because this goes down and it pulls down the required rate of return, which introduces the possibility of more projects being accepted. Okay, so let's see. I'm going to see if I can. Then we still invest. We don't change our decision. So I just calculate here the NPV again, which I know because I'm always comparing it to the internal rate of return for the cash flows alone. You see how handy that is? So still we invest. And what happens next is the next part of the addition to the case is imagine that the Bahamas line is more risky, and I use 5.5. Okay, Bahamas was 1.55 and I use 5.5. I think in the document it was even lower, but let's use 5.5 and see how that affects things. So this comes from some research about other airlines in the industry recently starting lines to the Bahamas, and they find that these are very risky. So when the market performs well, people will go to the Bahamas, right? So this is like, it looks like there's much more, a greater performance or greater revenue. This just performs better. But then what if the market has a downturn? This is going to really be adverse for the Bahamas line. So this is very sensitive, very risky, and making an adjustment for that computation, putting a new number in there using the same figures, you can go through it. We still use the 1%, we still use the historical market risk premium over the current past 6 years, and then we get a new figure, and look what happens. So we re-estimate and we find that the required rate of return is now, with the new project, with the new beta, this is too high. The required rate of return exceeds what we got as the internal rate of return of 10.26 for the project cash flows. So we will now reject the UAir project. Do not invest. As a last two last things to say. One is that a low T-bill rate and other things I mentioned will lower your required rate of return. So debt, right? Using debt Issuing debt will also lower the required rate of return for investors in the firm. These will both increase the likelihood that projects are taken. Okay. So projects are more likely accepted or pursued when the cost of capital is low or lower. All right, and that is it. Those are the notes. I know there's a lot, and you're going to have this week to review all those materials. Taylor will be with you. I am at a distance, I know, but if you want to ask me questions, you can. Here's an exercise. I do believe I sent you the solution for it. I'll double check. And here we have an extension to the WACC in the case that a firm issues not only common stock, but preferred stock. Preferred stockholders get paid, well, who gets paid first with profits are not profits, but as a priority, bondholders are paid. If there are profits that the firm decides to share with shareholders, then preferred shareholders are paid first, and there is some commitment to that, to them paying preferred shareholders first. And then common stockholders are residual claimants. So there's no promise from the firm. They are known as residual claimants. That's common stockholders. And that's different from preferred stockholders who have a priority. Okay? So you could calculate, just like we did, you could include an extra term for preferred stockholders and calculate the WACC. Okay, so that is it for now. I'm going to send you I'm going to make sure I sent the exercise for a problem doing this. And otherwise, you have all questions and solutions, and I will send you a few problems for an assignment. And next week, I will send you material, and we will talk about review, okay? So hopefully your time spent with Taylor is productive, and if you need me, you can let me know. But otherwise, I'm signing off for Sunday. Let me know if you have any questions. Okay, I'll stay on if you have questions, but have a great Sunday and a good week. I will talk to the dean about the test, okay?